Okay, so let's start from cash budgets. Cash budgets, again, breaks down to 4 components. First component we want to know is what's the money that we're collecting from customer? What's the cash inflow that the company is generating based on sales or based on services? Okay, so first table will look like this. We will need to refer to sales budget. You just did in one of the exercises. When we complete cash collection budget, inside the cash budget section, we need to refer to sales budget because remember that's where the money comes in from. Okay, so remember that earlier table we showed you that 60% of them were actually collecting by cash, additional 40% we're deferring to next month, right? So when we do cash budget for each and every month, it's not exactly the $50,000 sales revenue. We're only collecting a part of that. So 60% of cash we're collecting, that's definitely the cash inflow that we're getting. So this portion here transfers to cash collection budget. Now what about the 40%? It's deferred so that $20,000, $32,000, $24,000 becomes next month's cash collection. Okay, so if you just look at April alone, $30,000 comes from this entire month's sales. $16,000 actually is from March. Previous month's 40% that you haven't collected by cash transfers to April. If you look at May, $48,000 is itself this month's sales revenue, 60% of that. This $20,000 come from credit collection, which is the sales transactions you made in the previous month, April. Okay, so that said, the 40% of sales revenue you're not actually collecting in that month, you're deferring the collection to the following month. Okay, and just to make sure you understand this, 16% comes from the previous month. Okay, this comes from April, this comes from May, this comes from July. Okay, so this table here, again, what we're trying to do is just calculate what's the cash inflow that we're actually getting in the business. So it's not accrual sales. All the accounts receivables we're not capturing here. Those accounts receivables becomes actual cash collection in the following month. Okay, so after you put together these information, what we need to do is just add up the total cash we're getting. This part here will be transfers to the ending statement of cash flows at the end. Okay, so this is the first component of cash budgets. We're getting the cash collection part, the inflow of cash. And specifically, we're only listing each and every month's actual cash sales, not the accounts receivables. Accounts of receivables transfers to the second month. We're collecting it in the following month. Okay, so after cash collections, we'll be going over the cash payments, and we break it down into specific categories: payments on inventory, payments on operating expenses. Okay, so based on the name, if we want to understand payments on inventory, we need to refer to earlier the table on how much inventory we actually purchased. So remember operating budget, the second component, we understand the purchases level based on the expected cost of goods sold, based on the expected ending inventory. So here, let's say the company assumes that of all the accounts payable transactions, they're only paying in actual cash this month only 15% of it. So remember accounts payable, company usually when they do large purchases, they rarely directly pay the full amount in cash. Usually a portion of it defers to following month. Okay, so assuming this company estimates that about half of their inventory, the accounts payable, they're paying by cash. So half of it, you're actually making the payment this month. The other half, you're deferring it to the following month. Okay, so this is the same theory of the previous sales. We're collecting half of it, and we're deferring collection of half of it to the following months. Here, we're paying half of it exactly in this month. The other half of the accounts payable, we're deferring it to pay it out next month. Okay, so you'll be using the purchases amount that you got from the second table, slice it into half. Half of it you're paying out this month, the other half you're paying out next month. So who can tell me what is this? March, half of the purchases, half of the accounts payables from March. You transfer it and you pay it in April. Okay? So what are we getting out of this table is the summary of the payments that we're making each and every month, and also the aggregated amount. We'll be using this at the end also in statement of cash flows. So this is the second part of cash budget. And we have one last table here on operating expenses payment. So just like the previous two tables, a portion of some of the expenses we may be deferring to pay in next month. A portion we may be paying in this month. Okay, so the first two bullet points, the middle two bullet points here is basically a policy for salary and commissions payments in the business. So they assume that whatever salary expenses occurred in this month, they'll only be paying half of that in this month, half of that in next month. So if you refer to this table, let's say just the first line, commission expense. How much are we actually paying in April? Just commission expense. It will be half of $7,500, right? Because if we're paying half of them this month, the other half we're actually paying out by cash next month. For May, we'll be paying $6,000 this month, $6,000 in June. June's $9,000 commission, we're paying $4,500 this month, $4,500 next month. Same for July, half of $7,500 this month, half of $7,500 in August. Okay, so we'll be referring to the operating expenses that, again, we got an operating budget. Whatever the sales commission total amount is, half of them we're actually paying by cash in this month, so we copy half of the amount here up to the cash budget. And then for the other half, we're paying it this month. Now for miscellaneous expenses, the company assumes that all the minor expenses, they're paying it in full this month, so we just copy the whole thing to cash budget. So basically for each and every problem, you have to refer to specifically what's the policy for that business and use the percentages, apply it to cash budget to see which part you're actually paying, which part you're actually receiving. Okay, so for all the other fixed expenses besides salary, we're paying it in full in this month. So salary, again, salary and commissions, they're only paying half. So half of $2,500 is paid in this month. Half of $2,500 will be paid in next month. Okay, now rental expense, assuming that we're paying in full, just copy the same information to cash outflow. And then are you aware that some of the categories are not copied over to cash outflow? Which ones? Depreciation is not copied. Insurance expense is not copied to cash outflow. Why? Some of the fixed is copied over. What copies over means that there are actually companies paying out the money. Cash is being shifted out to somebody else, vendors, to staff, right? Why are we not copying over $500 for each and every month's depreciation over to cash outflow? What is depreciation expense? Remember that you got mostly the concept of it, because depreciation refers to long-term assets usage, right? And remember, it's a measurement. It's not really paying out this $500 to any vendors. Depreciation is just recognizing how we have been using expenses in accounting. So how we have been using the asset. We measure that the longer we use it, the lower value it has. So depreciation really is not any type of cash inflow or cash outflow. Right, we're not paying out any money. It's just a measurement in accounting that we estimate how long we have been using the asset. Okay, so every time when you look at income statement, when you see depreciation expense, remember that it will never be transferred to the statement of cash flows because we're not paying out any money. We're just estimating that every single year assets grow old, $500, or every single month. Okay, so depreciation just omitted. We don't have to transfer this to any cash budget statements. Okay, now insurance expense. Insurance usually in the companies, or for each and every one of us, it would be prepaid beforehand. Okay, so if it's a prepaid insurance, it's basically a type of asset. What you're doing here every single month to estimate just how much that portion of that prepaid insurance expires. So again, this $200, you already prepaid it before, we're not going to pay it again. So what insurance expense is just recognizing the portion of insurance that has expired. Remember, in financial accounting, we usually turn insurance expense, we debit it, and we credit prepaid insurance because we recognize that a portion of that prepayment has expired. So this is also not a cash outflow for later months. We're not really paying anything out because we readily paid this in full before. Okay, so whenever you see depreciation, whenever you see insurance, just exclude it. Look at all the other expenses accounts that we're actually paying by cash. Okay, so the upper cash flow budget for operating section, we're just including variable costs, sales portion, miscellaneous, fixed costs, salary, rental, and we exclude depreciation and insurance. Okay, so again, the blue highlighted numbers, later we'll be using it for statement of cash flows for the entire cash budget when we combine these tables. Okay, let's take a look at a combined cash budget. So we just broke it down into cash collection. We talked about cash payments specifically on inventory purchases. We also talked about cash payments on operating expenses. This is a table that puts together everything. So you see the first section here, we start from cash balance. So cash balance, where does that come from? From previous month and also previous month specifically balance sheet, right? Cash is the first account in balance sheet. So you'll need to refer to March 31st balance sheet to get that $16,400. That's the first line of April. And then for May's, you basically get it from here. All right, for June's balance, you get it from here. For July's, you get it from June's. Okay? But the first month in April, you need to refer to March. Now the following cash collection line, the second line here, basically is the table that we just did earlier. Remember, some of the cash sales we're collecting this month, some of them defers to next month. So that summary blue line number there, we transfer it to that table. The last table, cash budget, puts together everything. So if you total up what you had in this month in the beginning, add in what you're newly collected in this month, that gives you the total available cash, the third line. So for April, it will be $62,400. Okay, so upper part is the cash collection part. Now the middle part here, cash payments, we use whatever the payment we made for purchases, for inventory purchases. Remember, half of it this month, half of it next month. The blue highlighted number, total payments, which transfers to cash budget. Operating expenses, we just did a pretty lengthy table there. Variable expenses, fixed expenses. Again, we transfer the summary amount into cash budget. Okay, so this table upper part really just combines what we just did in the first three tables. Now, what is that $3,000 right below that blue line there? Buy a delivery truck. Okay, and this is a cash budget statement, so meaning that we actually paid out $3,000. Right? So that part really refers to this. What we just covered earlier was just the operating expenses inventory part. This problem in the book, it also tells you that the company wants to expand their long-term assets. They decided to purchase delivery truck. After doing investment, they think it's worth it. It will provide additional value to their sales activities. So they use up $3,000 to purchase the truck, which is also included in this cash budget if it's paid by cash directly. Okay, so we just add additional line. If the problem tells you there's long-term assets purchased using cash directly, just add it to the cash budget. So that's the $3,000. After that $3,000, the middle portion here basically is the total cash payments that you did, which again is the delivery truck payment, operating expenses payment, inventory payment. Add them together. becomes the $59,450. Okay, so label number 1 here, ending cash balance before financing. We're using whatever we paid subtracted from what we collected. So what we collected in April was $62,400 minus $59,450. You get the ending balance of cash, $2,950. Now it tells you additional information here, number 9, that the company wants to have every single month at least, they want to have cash balance on hand, $10,000. So usually companies will set a threshold for cash balance, just in case anything happens, if they have machine breaks down, if they have special orders. So perhaps they want to, different companies have a different threshold, but this particular one example, it tells you that we need to have at least $10,000 cash on hand. So based on this policy here, since the company in April, the cash fund runs a little bit low, it's only $2,950, they decide to borrow money instead. Okay, so this bottom portion here, the minus $10,000, we're comparing what we have, the cash we have, compare it against the threshold that the company set in place, $10,000, and see if we need to borrow money or not to have at least $10,000 cash on hand. Okay, so in April we actually don't have enough money. We don't have $10,000. We only have about $3,000. So we borrowed an additional $8,000. Okay, so think of this as a rainy day deposit. They want to have at least, or just like you and me, we may have a bank account that we want to have at least how much money. But usually for you and me, what we do is we need to earn money, right? For companies, they can decide to borrow money also. Right, so we want to have a rainy day deposit at least $10,000. To fulfill this, they want to borrow additional $8,000 to meet this policy. Okay, so after borrowing $8,000, now the total cash balance they have is $10,950. This portion here, they're paying back that $8,000 on a monthly basis. They break it down to 8 installments. Every single month they're paying $1,000. They're also paying interest on it. Okay, so the bottom portion of this cash budget, if the company did not borrow any money, you would not have this section here on financing. This only exists when the company do borrow money, and this is the portion that they borrow, the principal amount. This is the installments that they paid every single month. Okay, but in case the company does not finance any money from other short-term debts, long-term debts, the statement basically will stop on top over there under number 1, cash balance before financing. This tells you that the principal amount is $8,000, right? And it tells you that the interest rate is given to you, 12%. So basically, if you break it down to 12% is a yearly interest, then you divide it by 12 monthly basis, this is how much you're paying. And since you're paying $1,000 by installments in the first month, so second month the interest rolling will be less. Third month, lesser. Okay? Okay, so this chapter, the example given in the book is actually pretty good since it's a more complicated example. So if you go through the policy-wise, what's set in place in the business, financing issues, what happens after they borrow money, basically we're just boosting up cash balance. So if you understand these things, you basically have a pretty good concept of the entire master budget. Okay, so make sure over the break, try to go through this example in the book. And this is pretty much all about cash budget. Breaks down to 4 components: the part of the cash that you're collecting by sales, the part of the cash that you're paying for inventory, part of the cash that you're paying for operating expenses, and perhaps additionally you may have cash payment for delivery truck, for long-term assets. And if the company has a threshold for having or has a set in place balance that they want to have a certain amount of cash on hand every single month, you compare the cash amount what you have in each and every month, see if it meets that threshold. If it doesn't, like this example, the company may decide to borrow money, but then later on, each and every month, they may need to be paying installments. They may need to pay installments and also interest on it. All right, exercise time. Let's try to do an example on cash budgets